Hey, it's Kristi. Thank you so much for joining me for an episode. In this one, let's talk about how to have an optimal credit score. Thanks so much for joining me for another episode. I want to start off by also saying I have a podcast available on all platforms, and it's called Credit Coaching by Kristi. They're short episodes, they run about 10 minutes each, and I usually drop a new episode every single week. So if building or rebuilding your credit is really important to you, go there for some very significant tips, and I dig a little bit deeper on that information from what I'm sharing here. So let's dive in on how to have your very best credit score. So first and foremost, you need to have a really nice mix. So what does that mean? There are a couple different types of credit lines. We call them trade lines, and a trade line is either going to be an installment loan or a revolving account. So a revolving account, you know, as a credit card, or if you own a home and have a home equity line of credit, sometimes called a HELOC, that's also a revolving account. So what does that mean? That means that you have a limit and you have a balance, and your payment is based off of what your current outstanding balance is. There's also something that's called the debt utilization equation, and that debt equation is based off of how much of your limit you're borrowing. So tip number one is don't use more than 30% of what is available to you on your credit cards. Try to keep that balance nice and low. Another great tip is pay that balance owed, or the minimum payment that you intend on making, one full week prior to your bill cycle. So you'll know when your bill cycle is. If your payment is due on the 19th, that's your bill cycle. Your bill cycle cuts then on the 19th. If you pay approximately 1 week before that bill gets dropped, you can avoid interest if you pay it in full, or if you pay down that payment, then you can pay based off of that lower new amount. But just make sure that if you make that payment a week early, that you don't miss that window of opportunity where they're like, no, you haven't made this statement's payment. It can be a tricky little spot there. Every credit card is just a little bit different. So make sure that you're paying for that month so you don't have to make double payments. That'll get you in trouble if you don't have that budgeted in your account. So that is revolving accounts. Let's go back to installment loans. So an installment loan is going to be, for example, a mortgage loan, a personal loan, student loans, and also your car payments. So an installment loan is an agreed amount that you've borrowed from the beginning. Your payment is based off of, usually principal and interest payments are based off of that original loan amount that is given to you. So no matter how much you pay down over time, let's say you just did a big chunk against your car payment, that payment next month is still going to be that full principal and interest payment that's due. Sometimes I see some creditors push your next payment out. So let's say you made a big extra payment on your auto loan. They might say, hey, your next payment isn't due for 3 months. Don't get caught in that trap, because they're still accumulating interest because there's a per diem. That is Latin for per day. So you have a daily interest charge. So if you intend on paying down faster, having an earlier payoff than what's scheduled, pay off a little early, pay off a little extra, and then what you're going to do is you're going to shorten that amount of time at the end of what your agreed time period is. So if you had, say, a 60-month repayment on your auto loan, but you paid $50 or $100 extra every single month, and maybe you paid a few days early, you're actually going to be paying that off in full earlier than 60 months. Same with your mortgage. If you pay a little extra or a little early, it's no longer going to be a 15-year or a 30-year mortgage. You're going to shorten that end period. So I also have a video that is talking about biweekly payments, and it goes hand in hand with what I'm teaching right now on installment loans. So check out that video if you'd like to figure out how to shorten that term on what that payment that principal and interest repayment period is, where you can shorten that down just a little bit. So a perfect mix of credit is having at least one credit card and at least one installment loan. Now, here's a caveat. If you have student loans, which are an installment loan, and they're in deferment, they're not helping you and they're not hurting you. They're just kind of neutral because they're hanging out there. And although they are accumulating interest, which means now your amount that was loaned to you is actually less than your amount due from you, that part can hurt you. But as far as the payment history on an installment loan, if it's in deferment, you're not making payments, there's really nothing to report. So it's not helping, it's not hurting on that aspect. So you want an installment loan that you're actually making more payments on. Your payment history makes up 35% of your overall credit score. So it is so very important to not have any late payments. You have a late payment, it can really hurt you. Now, here's the crazy thing about the algorithms when it comes to the credit reporting bureaus. If you have a really exceptional credit score and you have a late payment, you're gonna fall in your score much harder and much heftier than you would if you had kind of a lower credit score and then you had a late payment. So the higher you are, unfortunately, the harder you fall. What's important in this perfect mix of at least one installment loan and one credit card is you want your credit card to be a bank issued credit card as opposed to a store card, right? So like a Capital One, Chase, or Discover card is going to have a better impact on your credit score than say a Macy's credit card would. So you want to have at least one bank issued credit card. If your score is really terrible right now, consider a secured credit card. Do not max that baby out. Use it, pay it back, use it, pay it back. And remember to keep your balances at 30% or below. Another thing is do not close your oldest trade line. So now we know a trade line is either an installment loan or a credit card payment out there. Let's say you have a credit card that you got in college and that was 15 or 20 years ago and you don't really use it that often. Do not close that baby up. Here's where a lot of people fail. I see where some of the comments when they get credit pulled, as far as what the credit reporting bureaus say out there on how they came up with their credit score, not a long enough history. And I've heard people say, I've had credit for 15 or 20 years. You may have started establishing credit 15 or 20 years ago, but as soon as something is closed or as soon as something is paid off in full, if it's an installment loan, it is closed. So if it's no longer reporting, then your credit doesn't go back as far as when you started establishing credit. Your credit history is really only as deep as the length of your open trade line that you have right now. So if you've got that credit card from college, even though you don't use it, maybe put some gas on it and then pay it off. Maybe put some groceries on it and then pay it off. Sometimes the credit card companies will cancel your card due to inactivity. So we want to keep that open and active. And if they charge you an annual fee, maybe that's a little bit different. You'd have to weigh out the pros and cons there. But if it's just a regular old credit card that doesn't have any points, doesn't have any credits for travel, doesn't really have the very best interest rate, I would still encourage you to keep it open and just use it every once in a while. Just use it and then pay it off so it just stays in that long-standing history for you that will help you have a very stable and beautiful credit score. So these are my tips for your best credit score possible. If you've got a lot of disputes out there on Credit Karma and some of those other retail agencies, they're going to just exclude that from your credit score. So it's going to actually be an artificial credit score. When you go and apply at an agency, say a lending institution for a car loan or a mortgage, those disputes don't get excluded like what you see. And so we're going to actually see a lower credit score most likely as opposed to what you're seeing there on the retail side, because we do calculate in that collection or that charge off or whatever the case is there. So I also want to leave you with this. There are literally dozens of scoring models that are used out there. And depending on who you are getting credit from, whoever you're requesting that credit from, they're going to use a different scoring model than maybe what you're seeing on the retail side. And it can be very, what's the word I'm looking for? Discouraging when you think you have this credit score and you go and apply for something, an auto loan or a mortgage, and you find out you have this credit score, which is typically lower. So just know that it's not your fault. It's these crazy dang algorithms that the credit reporting bureaus use, and all of these different models. Some of them are based on risk, like it would be for a mortgage loan application, as opposed to what you're seeing from Credit Karma, who is in the business to hopefully get you to click on one of those recommended credit card card links, that's how they make their money. They're actually a marketing agency, so beware of that. So they want your score to be as high as possible so they can make as many generous recommendations on all sorts of cool credit cards that help you feel, really important and swanky to have. So watch out, don't get caught in that trap. And I hope that I brought you lots of value having a better understanding of credit. Come see me at Credit Coaching by Kristi in the podcast world. And until next time, my friends, stay well.